Good afternoon. Welcome to this webinar organized jointly by IMC Chamber of Commerce and Industry and of course MCX, India's leading Chamber of Commerce, diversifying the investment portfolio with commodity derivatives. We have with us this afternoon as a guest of honor, Mr. Tanil Kilachan from the famous Kilachan, the House of Kilachans. Of course, in the city of Bombay and across India, almost everyone in business or in the business circles, they all know the House of Kilachans. And Tanil Bhai Kilachan is a former president of the IMC Chamber of Commerce and Industry, and currently is a co-chair of the IMC ERTF, Economic Research and Training Foundation. He is extensively connected, networked very well across India and across the globe with several educational institutions, social institutions, commercial institutions, chambers of commerce, etc. Tanil Bhai, it's an honor to have you here, and I request you to deliver the welcome address as a special address. Yeah.
Thank you, Chandrasekhar. Welcome everybody, all the speakers concerned. Today's event has a special significance because Sebi has announced the celebration of World Investor Week 21 during November 22nd to 28. Today's event is part of our celebration of World Investor Week with the theme, Investing with Knowledge, Way to Financial Independence. IMC Chamber has a unique distinction. It is a Sebi accredited training institution for commodity derivatives, and we conduct a large number of events every year to spread awareness about commodity markets as well as train and educate value chain participants. IMC and MCX both have enjoyed a mutually beneficial relationship in recent years. This webinar is part of the ongoing effort of IMC and MCX to jointly promote awareness, training, and education about commodity price risk management among the value chain participants and investors. There are many avenues for investors to invest their money: fixed income, bonds, debt, foreign exchange, real estate, etc. In recent years, commodities too have also become an asset class. Globally, investor interest in commodities is rising. I am reminded of an old adage, don't put all the eggs in one basket. The logic applies to investment too, as it may not be wise to place all investment in one asset class. Investment in commodity derivatives can prove to be a good portfolio diversifier. Expert speakers we have today will share with us their views on the importance of diversifying the investment portfolio by investing in commodities derivatives and derivatives. Once again, I welcome the speakers. I would also like to say that IMC has been having awareness programs not only in Bombay but outside as well, as well as Mumbai, both in person and online. Ahmedabad, Rajkot, Sangli, Nagpur, Bhopal are some of the places where we've had this and conducted the awareness program, very ably led by Chandrasekhar. Before I conclude, a few words about IMC, established in 1907 and having its headquarters in the heart of Mumbai. As an apex chamber of commerce, IMC is proud to be associated with these types of events. It has a membership base of over 5,000 and over 150 trade associations affiliated to it. Together, it represents and advocates the interests of over 400,000 business and industry establishments across the country from diverse sectors of industry. The IMC platform offers its members the benefit of global networking opportunities to explore and expand business. Importantly, it's a Sebi accredited training institution for commodity derivatives. Once again, welcome to you all, and I'm looking forward to fruitful discussions of this seminar. Thank you.
Sir, thank you very much for this wonderful welcome address. I just want to pick up on that just one line that you said that was so impactful and telling. Don't put all your eggs in one basket. I think that's actually the theme of today's webinar, where we are going to be talking about how, as you rightly said, there are so many asset classes, so many investment avenues, but you have to diversify your investment portfolio so that the risk reward profile keeps changing, and that eventually you come out a winner. Thank you very much, sir, for this wonderful welcome speech. And with your permission, now we will go ahead with the technical presentation. Just allow me 1 minute. I'm going to share screen and talk about share screen and then go to my presentation. Here it is. Slideshow. All right. So let us talk about this IMC MCX webinar this afternoon, diversifying the investment portfolio with commodity derivatives. As Mr. Kilachan pointed out, this is a part of the World Investor Week celebration, and this is obviously is supported by Sebi. And again, let me at the risk of repetition mention what Mr. Kilachan mentioned, that IMC is a SEBI accredited training institution for commodity derivatives, and in this capacity, we keep doing a very large number of events from time to time. Now, let's talk about the subject. Without much ado, let's get into the subject. There is a wide array of investment choices available for the investors, and again, as Mr. Kilachan pointed out, investment avenues, fixed income, debt, equity, currency, real estate, even art is now an asset class. People are investing in art, and the latest is cryptocurrency, NFT, non-fungible tokens. All kinds of investment opportunities are there for investors. Amongst all this, over the last 20 years or so, commodities have actually emerged as a new asset class. Although crypto and NFT are very, very, very real, very recent, but commodities are at least 20 years old as an asset class. Generally, commodities are perceived as a consumption asset class, and equities are seen as investment asset class. But over the last 20 years, gradually, commodities are not only a consumption asset class, but they are also now being largely perceived as an investment asset class. And commodity derivatives trading has actually elevated the status of commodities from being merely a consumption good to, of course, an investment avenue. And therefore, the perception about commodities has been changing rapidly over the last couple of decades, and which is very positive for the commodity market. And more important, investor interest in commodities is rising across the world, globally, particularly in the developed market like the United States and even in Europe. Your hedge funds, mutual funds, pension funds, all these invest in commodities, quite apart from HNIs investing in commodities. Therefore, investor interest in commodity derivatives in particular has been rising and will continue to rise. There is no doubt at all. Why is this interest in amongst investors? Amongst investors, there is renewed and rising interest to invest in commodities is simply because commodities, some of the commodities have often outperformed other asset classes. In fact, the commodities have given better returns than even equity investment. Gold is a classic example. From the year 2000 till the end of 2022, gold prices increased year on year, double digit for 12 or 13 years. And then therefore, I think that kind of a performance of an asset class or an asset market is something incredible. There are various reasons why gold market performed the way it did, but that's a great example of how commodities have come to the fore, attracting a lot of investment. Now, Sebi, the Securities and Exchange Board of India, which is India's commodities derivatives market regulator, and also, of course, the equities market regulator. We have unified the regulatory oversight for both equities and commodities. Sebi has taken several initiatives in the last 2 or 3 years. Now, what are these initiatives? The intention one is to deepen the market and widen the market. And therefore, the initiatives cover launch of new products, allowing new participants to come in, and of course, allowing new services. Therefore, as a part of this deepening and widening of the market, mutual funds are allowed to trade commodities. Alternate investment funds, category 3, they are allowed to trade commodities. And then foreign investors with exposure, foreign entities with exposure to Indian commodities, they are allowed to trade commodities, commodity derivatives. A portfolio management service is allowed. Therefore, there are new participants now coming into the market. Then you have products, which is index trading is allowed. And index is such a wonderful investment avenue. Options trading, which was allowed. India used to have a thriving options market in the 30s, 40s, 50s, and 60s. But in the mid 60s, for some reason, the government of India banned forward trading, and obviously with that, the options trading also. But now options are allowed. Very recently, options, the last 2 years or so, options trading in commodities is permitted. And you have options on futures and options in goods. All this is encouraged by Sebi. And these products are doing reasonably well in the market. In futures contracts, and which is what has been happening over the last 15, 16, 17 years. But in the last 2 or 3 years, because of the deepening and widening of the market, more variants have found space in this ecosystem. Options contract, as I talked about, options contract is nothing but an insurance policy. Then you can have options on futures, and then you can have options in goods. Then you have put options and call options, etc. I'm not going into the details of all this, but these are all variants available for market participants and for investors. So an option buyer has to only pay a premium, like a person taking out an insurance policy pays a premium to the insurance company. Then an option buyer has to only pay a premium and is protected against adverse price changes to the underlying commodity. For all this is now picking momentum very rapidly. Similarly, index trading. What is the index? Nothing but a reliable benchmark for a specified commodity group, and then it has so many benefits. Continuity. Then it allows market participants to trade and take a view on the on the overall market. It has high liquidity. In fact, we have found index futures tend to be more liquid than their components, because index is nothing but a sum of its components. But the components may have certain liquidity. The index has much greater liquidity than the components themselves. And it's so cost effective, so easy to trade. It's a low volatility, low risk, low margin, low margin investment opportunity. Now, we need to examine further, explore further, and I'm sure Vikram and Debo will talk more about this. How commodity derivatives are such a wonderful avenue for investment. Primarily, commodity derivatives, quite apart from value chain participants who need to hedge their price risk, it also allows investors to come into the market, particularly institutional investors like mutual funds and AAF3, third category, etc. All those new participants can actually trade in the market. Primarily, they will all be investors to benefit from changes in prices. Now, index, for example, if one were to invest in index, there are no delivery hassles. You don't have to give delivery or take delivery of any commodity. No such hassles. And then there may be one index, but there are sectoral indices, sub indices also possible. And I'm sure Debo is going to talk about all the sub indices that MCX has launched. For example, MCX has ICOMDEX, which is a composite index. Then within that, they have bullion, they have base metal, they have energy, and all those sectoral indices are available. Therefore, I think there's a even within the commodity space, there is such a wide choice. Okay. Now we need to come to portfolio diversification. A very well diversified investment portfolio actually reduces the risk. After all, markets are volatile. All of us know how volatile the markets are, particularly the asset markets are volatile. There are so many factors that buffet the market, whether it is economic growth or geopolitics or monetary policy or currency or weather in case of agriculture commodities, the role of funds. I mean, there are so many factors, macro and micro factors that buffet this market, that all the asset markets are usually quite volatile. And then we also have to look at the macro environment. There is something called a risk-on environment. There is something called risk-off environment. Last year, because of the pandemic and the COVID, lockdown, disruption to supply chain, we had something called a risk-off environment. People were all inward-looking. But now that things have improved, there is a very highly liberalized monetary policy. Life is coming back to normal. Economic activity is picking up. Now there is a risk-on environment, and therefore people are now investing more and more in the stock market, and stock market is moving. And then therefore I think these risk-on, risk-off environment usually alternates. Okay, and therefore we need to know when that environment is going to change. And there are some commodities which are called growth commodities. For example, I would classify crude oil as a growth commodity, copper as a growth commodity, cotton as a growth commodity. Why? Because there is a strong positive correlation between economic growth and commodity consumption. As economies start to grow, commodity consumption also increases. And therefore, these are called, as I said, crude, copper, cotton. These are I call them growth commodities, because they have very strong positive correlation. Similarly, there are some commodities called safe haven commodities. Gold, for example, is always known as a safe haven asset or a good hedge against inflation, etc. For in times of uncertainty, gold prices will rise because all the investors will flock to gold. Or we need to understand the psychology of the market participants, and therefore investment in commodity derivatives is an effective portfolio diversifier in any situation, whether it's a risk-on environment or a risk-off environment, whether there is economic growth, rapid economic growth, or slow growth, or even a degrowth. There are some commodities or the other available as a useful investment vehicle, which will lead to diversification and which will de-risk de-risk any risk that may be attracted by the investor. But most important, I would think commodity market participants, the derivatives market participants must have enough product knowledge and market knowledge. After all, knowledge is power, and therefore the investors have to invest with knowledge. And all the decisions in commodity investment must be based on sound research and commercial intelligence. And as again, let me go back to what Mr. Kilachan said. Don't put all your eggs in one basket. Very important. Don't club all your risks under one asset class. Spread your risk and balance your portfolio and reap rewards. And in this spreading the risk, balancing the portfolio, and in reaping rewards, I think commodities must find a very specific place in the portfolio of any investment, because commodities have often outperformed other asset classes, and it's going to be a great investment opportunity. I think with this, I will stop. I probably exceeded my time by 2 or 3 minutes, but I just want to thank you. But I have a disclaimer which I make in every single event. I am not a trader. I don't hold any position either in the physical market or in the derivatives market. I'm a student of this market. I'm also a teacher of this market, because I teach this subject in many B schools, and therefore I have no financial interest in this market at all. So let me stop here. Good luck. God bless you all. Stay safe. And I'll now invite our friend Vikram Dhawan to share his thoughts. Vikram, the floor is yours.
Thank you, sir, and thank you, everybody. Thank you, Kirachanji, and all of you which have taken your time to join this discussion. Just to give a brief introduction about myself, my name is Vikram Dhawan. I am Head Commodities and Fund Manager at Nippon India Mutual Fund. And perhaps let me give a disclaimer also that yes, we are a fund house which does invest directly into commodity and commodity derivatives, especially gold, silver, metals, and energy. So obviously, if I sound too bullish on commodities, maybe you should take it with a pinch of salt. So yeah. So see, the why we should invest in commodities. Obviously, the answer is to make money. But I think obviously for that reason we invest in equity, debt, and real estate, and so many other cryptocurrencies also. But I think most importantly, irrespective of the asset class, it is very important for an individual to be very, very sure about the objectives of investing or trading into a market. What is the objective of that? Is it simply tactical play, buy low and sell high trading, which we call it? One other word for that is trading. Or is it to hedge yourself against certain risks that you carry in your portfolio or in your business? Or it is to diversify your portfolio. Why you need to diversify your portfolio is because, as you must have seen in the past 2-3 years, the kind of volatility we have seen the worst of worst and the best of worst in almost every asset class. Now we can all say, from March last year, everything has gone up by 100%. But we all know that's not the true story. In between, it went to minus some big numbers also. Every asset class, even gold also fell down. So what it means is that, at the end of the day, it is not just absolute returns. It is the risk-weighted returns which matters, which means the less volatile are your returns on year-to-year basis, the better it is. Because what may happen is, and which Murphy law always holds good in the investment universe, that when you want to sell your securities, the market is down, and when you want to buy it, it's always up. Let me start the stopwatch, because otherwise I tend to, yeah. Yes.
what can go wrong will go wrong. That's Murphy's law, and therefore you need to guard against it. Yeah, sorry.
Absolutely. And if you are invested, it will go wrong a lot more than what you can imagine. So yeah, I'll talk about in brief how you can ensure that you don't maneuver yourself into that disadvantageous position. But there's a lot to talk about commodities, and but I'll try to be very brief and precise. Well, first of all, why do we need to invest in commodities besides making money? Every country has its own normality. And a Canadian or an Australian will have a different perspective about commodities. An Indian will have a different perspective because we are unfortunately a capital and a commodity deficit country. We have a lot of commodities, but we don't have crude oil, we don't have gold, very little silver, and so far and so forth. And most of the key metals which will be in vogue, especially from the point of view of technology and environment, the disruption which is happening, like nickel, lithium, we don't have anything to talk about. So we are a commodity deficit country. Now see what is happening on the crude oil front. Crude oil prices have gone up very sharply, and it is affecting the inflation globally. It will affect the inflation in India also. And we don't have, in the entire equity universe, we don't have a true blue oil producer. We have oil companies which are very well diversified, and they are not positive. The correlation may or may not be very high with regards to the crude oil prices. If at all, some of the companies are negatively correlated with the crude oil prices. So there are certain risks which normally cannot be hedged or diversified away from the capital markets, especially from equity and debt. So for that, you need to have access to commodity markets. And thanks to Sebi, the vision that they have and how they have developed the market in the past few years. I mean, today we are actually, there are a few fund houses as of now, but I'm sure the tally will go up as we go ahead, who are actually directly investing into commodities and offering diversified products like multi-asset fund. We also have a multi-asset fund. So that is one thing. We are a commodity deficit country, and we need to have the wherever you can buy a zinc company, you can buy an aluminum company, but you cannot buy a nickel company. You cannot buy a gold mining company over here. So there are restrictions, and it is not easy to there is an LRS route available in which you can send your money across to invest in a gold mine, but it's difficult to keep your wrap your head around Indian companies. You can imagine you need to be extremely fully invested into that as far as time and resources are concerned if you're really investing into anything besides your home country. So sometimes perhaps it is easier to take a direct commodity risk if you have an investment view or if you have a hedging view. So that is one reason why you should be investing into commodities, because there isn't any universe, there isn't any alternate available to participate from the other markets, which is debt or equity. And second, obviously, is that from the point of view of the investment community. Now, if you are an investor which believes into wealth creation through capital markets, and that is the first thing. I mean, you believe in stock markets, debt markets, mutual funds, and all. That is a prerequisite for this, for my conversation to extend on this point. If you believe into that, then I think perhaps you should be looking into exchange listed derivatives. Now, what are derivatives actually, and how did they begin? So derivatives are basically, in the earlier times, if you were in London and if you wanted to buy copper from Chile, there was a 3 months shipping period, and so you could settle the price on day one, and the delivery used to come after 3 months. That's why you have a 3-month contract of copper, aluminium, and so far and so forth. And as the technology and advancement in communications, transportation and communications improved, these became listed. They could be listed on commodity exchanges or stock exchanges. So derivatives are nothing but they are a right, and also if you are trading into futures, it is a right and also an obligation to buy or sell the commodity that you're holding. So it's actually a proxy, or more than a proxy, for holding the commodities. Why would you prefer to invest into derivatives vis-a-vis the direct commodity? Obviously, none of us want to hold half a tanker of crude oil, or maybe 10 truckloads of zinc, or parked somewhere. Especially in Mumbai, it can be, the parking itself will be more expensive than the money you would ever make out of it. So derivatives become handy for the investors who want to take exposure into commodities for whatever reason, hedging or diversification, etc. Now, there is a very big myth which is surrounding the derivatives, because right from the the Asian crisis till now, from mid-90s till now, every few years you have some derivative trade going horribly wrong, and it sort of covers the center page of all the newspapers across the world. Yes, derivatives are something which, if you don't understand them, then it is better to, as Mr. Chandrasekhar very rightly said, that the only weapon we have in this market is basically, the knowledge. So it's very important to understand the derivatives, how they work. Obviously, I'm sure IMC and MCX have conducted a lot of these such webinars to educate people. And if you haven't attended, I would request that you see a recording of that, or maybe a request for another one. So it's very important to understand how the derivatives work. You see, now, as far as the mutual fund regulations are concerned, what SEBI has done is it is completely de-risked the commodity derivatives, which the mutual fund invest into, or rather, I would say de-risk the entire fund as far as commodity derivatives is concerned, and that is also relevant to the equity derivatives also, and debt interest rate derivatives also. So what the regulation says is that you cannot have any leverage, which means if I have 100 rupees to invest, I can only either invest 100 rupees in the underlying commodity, physical commodity, or I can invest 100 rupees of value of the derivative. So which means there is no leverage. It's not that we are putting 10 rupees and buying goods worth 100 rupees. So what it does for us is that you basically the returns plus or minus that the mutual funds or anybody who's regulated by SEBI, any investment entity which is regulated by SEBI, I'm limiting it to PMS and AIF, unless otherwise mentioned, the leverage is not permitted. It is permitted in AIF, but that's a different topic altogether. So obviously, when you are investing through mutual funds, there is no leverage risk. If we are investing into gold derivatives, the fund of ours is investing into gold derivatives. If gold prices go up by 10%, we make 10%. If it goes down by 10%, we lose 10%. It's not that if it goes up by 10%, we make 20%, and if it goes down by 10%, we lose 30%. There's no leverage involved. It's 1:1. So that is one thing which when you're investing into derivative, it is very important, because you may be enticed. You may have a very enthusiastic counterparty which may, urge you to take leverage. But, I mean, listen to all the gurus, whichever investment guru you follow, whether it is Warren Buffett or Soros, they've always said that leverage is the weapon of mass destruction, the surest weapon of mass destruction. Whether it was, 2008 was nothing but leverage taken on the housing markets of US. And the Asian crisis happened because there was extreme leverage on currencies taken by the so-called tiger economies, and so far and so forth. So every crisis have emerged because of any form of leverage in any market. So stay away from leverage. If you are somebody who uses leverage you frequent the derivative markets, then you are not an investor. You're basically a trader, and that too a short-term trader. So obviously this discussion will not be that much pertinent to you. Now, so I have just a few minutes left. But so what I'll do in the next few minutes is how to use this derivatives to achieve your goals of investing, trading, or hedging, etc. First, let's talk about the difference between investing and trading. Now, anything which is bought or sold, which is you take a long or a short position with a time horizon of less than 1 year, is short term. And anything which you invest into for anywhere between 1 to 3 years is medium term, and anything beyond 3 years is a long term. So first of all, you need to be very clear what type of investor you are. If you're investing with a time horizon of less than 1 year, then you're a trader and you're not an investor. Then possibly you would need tools like stop loss, profit take, and all. It's more of a maybe a lengthier version of BTST, buy today, sell tomorrow. So I'm not an expert in that, and I wouldn't perhaps there are people who may be able to guide you on that. But if you're looking at commodity from a longer term perspective, crude oil or gold or whatever it is, for whatever conviction you have, then there are few things that you need to be very important, take into account. When you are an investor into commodities, first of all, the time horizon is of the key, and secondly, the problem is, and I think this is not only limited to commodity markets, it's also very much the case in equity, and mostly in the equity markets, that we all start as long-term investors, but when we make a lot of money or lose a lot of money, we become short-term investors. I mean, there's a joke on the street that if you buy a stock and if it goes down by 20%, you become a long-term investor because you don't want to sell. And if it goes up, then you want to take your money and run. So if you have to be very clear about it, that once you are an investor, there will be undulation in the markets. Market will go up and down. And at that point of time, you should not be reactive. You should be very clear about what are your investment goals. What is your target returns and all those things. So all these things you need to be very clear about. There's nothing wrong. Nothing is cast in stone. You may have a target return or whatever it is. With experience, you might change it. You may start with a 40%, very over ambitious, because in times of crypto, anything which is giving you less than 100% in a week is thrown out of the window. But let's see how long this party lasts as well. So first of all, be very clear on the returns. What are your target returns and what is the objective of that? Now, how to, very quickly, I'll touch upon how to decide what kind of returns you should expect from each commodity. For instance, if you're invested into gold, now gold has a long-term volatility or standard deviation of 8%. So if you are an investor which is holding a portfolio with a time horizon of 1 to 3 years, then anything between 1 to 3 standard deviation, 8 to 24% is something that you can make a ballpark figure. But let me tell you, as I mentioned earlier, Murphy law will hold good. The moment you exit at 24%, the market will rally to 40%. So you need to take all these things on your chin, and the reverse will also happen, that market falls by 8% or 16% and you buy and then it falls another 16% from that. So you will go wrong once in a while. But what will make you a winner is that if you have consistency, if you learn from experience, and if you don't repeat the same mistakes. So that is one thing as far as the target returns are concerned. Now, how much commodity to hold in a portfolio? Now, again, there are a lot of things, tools available, Sharpe ratio and portfolio, there's a whole lot of portfolio theory involved in it. But there are 3 rules that you need to be very careful about. First of all, if you are a completely tactical investor, which means you are holding this commodity purely for returns, then I think what you should do is you should do a simulation on what is the best and the worst case scenario, and arrive at a mix of commodities where you can stomach the worst case scenario. Because unfortunately, what happens is the best time to invest in commodity is when your portfolio is down. And at that time, you will have the urge to liquidate. But if you have constructed a portfolio wherein you can write to the worst case scenario, obviously until something like a pandemic happens or a 2008 crisis happens, those things are, Six Sigma events. But the fact of the matter is that first thing is draw your boundary line, how much losses or how much pain you can tolerate, and construct the portfolio based on the past performance. See gold, what was the worst year in gold? Can you stomach it? That is one thing. Secondly, in terms of what all commodity to choose, I would say ideally you should be only choosing those commodities which you know about, which you understand, There's no point going on somebody's tip because it's not his money or her money. It's your money. If you don't understand any commodity, don't invest into it. And you may take some, there are two philosophies in the market. One is the Warren Buffett's philosophy, and the other is the George Soros philosophy. Warren Buffett, before investing into a company, would read past 10 years balance sheet. George Soros invests first, and then he reads the balance sheet. So, you have to see which kind of investor you are. Anything in the middle is also not too bad, but you have to find the right balance. So that is second most, important thing as far as investing is concerned. And the many more things to be seen. But last but not the least, it is very important to, to have an optimal rebalancing of your portfolio. We may start the year, in January, we may have a view on commodities, but, in 3 months' time or in a 4 months' time, the fundamentals may change, the world may change, something new must have happened. So it is very important that irrespective of what your view is, because the one mistake which people do, they become so courageous that, they say, okay, fine, I bought silver, it's gone down by 20%, fine, I'll wait for it. Then it goes down by another 20%. So when something is down by 60, 40%, for you to come to above water itself will take you a lot of time. So have an optimal rebalancing portfolio. Avoid looking at your portfolio on day-to-day basis because, as they say, that the screen prices conspire to confuse you. Don't be affected by that. I think I have to finish because I've already exceeded my time limit. And so yes, so rebalance your portfolio, whether it is monthly or quarterly. Ideally, it should be quarterly.
Vikram, please take your time. Take your time. There is no hurry. Please, sorry. Go ahead.
All right. Okay, sure. So it should be, the fastest it should be a month, and the longest it should be 6 months. So ideally, we at mutual fund would do it on quarterly basis. And the objective of the rebalancing of the portfolio is very clear. We look back and see, in the month of January, why we were bullish on gold, and the points that we had jotted down then, how many of them have actually, been realized, and how many of them were incorrect, because at the end of the day, we are in nobody can predict the future, how it's going to happen. But, unfortunately, investing is all about trying to figure out what the future is. And that's why you make money in investing, right? If it was predicting the past, then nobody would have made money on it. So, yeah, these are the few things, and there are a lot more, but I think these are the few basic things that you need to, hammer out and pin it somewhere on your wall. But again, I would say that the most important thing about you is know yourself, what kind of a person you are. What is your objective? Are you a trader? Are you an investor? Do you have patience, impatience? Because eventually, irrespective of whatever education I have or you have, we will always have our imprint of our personality on our portfolio. So, try to understand what kind of a person you are and where you are. If you're impulsive, then there's a possibility that you would be buying high and selling low. So, try to curb all these things. And, there's a very famous saying in the world, wherever you go, that whilst there are a lot of people who, get lucky, but for the rest of us, it takes a while of experience to get there. And while of experience, with a promise to yourself that you will not repeat your mistakes. And anything, whether it is commodities, equities, or even crypto also, if you use these few basic principles, I'm not saying we all will become billionaires, but at least we will avoid ourselves pushing ourselves into a corner where our portfolio is down by 40% at the bottom of the market, and instead of buying, we are selling that portfolio because we are leveraged or whatever is the distress. So yeah, so whenever you invest, look 3 months forward, your next rebalancing date. Suppose if the market goes there or whichever place, what will be my action? And last but not the least, you should have a plan, an exit plan. When do you want to exit? Whether it is at the bottom or at the top, at a rally or at a decline, but have an exit plan. And that exit plan can either be model driven, or it can be a simple, I've seen investors who have a very simple objective. I want to make on an average of 30%, 20% returns annually, which means if I start cutting my losses at 10%, and I start taking profits at plus 30 or 40%, on an average. So have some sort of a thing which works for you, It will not be perfect on day one, but if you go along, you'll figure out a way to, have the right balance. At least, if nothing, I don't know how much money we all will make at the end of the day. It's also, because Almighty is, God is also there. It is written the destiny. But I think what will happen is that we will not have sleepless night, and we will not have, the journey will be extremely enjoyable. And most importantly, we all will learn something, and we will all come out as better people, as better characters out of all of these. So, all right, I'll stop over here, and I'll pass on the the mic to the next speaker, to Mr. Chandrasekhar or Anita, whoever wants to take it over.
Oh,
thank you very much.
Thank you, Vikram. I think this is awesome, absolutely erudite speech that you delivered. Very, very important messages for the participants. You talked about risk-weighted returns, extremely important. The markets are not going to behave the way you want them to behave or you expect them to behave. Markets are not going to do that. And secondly, of course, importantly, under Indian conditions, because we are a commodity deficit nation, I think there are a lot more challenges. But again, these challenges are also going to be providing us enough opportunities for investment. But you will gain only if you have adequate product knowledge and market knowledge. I think that's the underlying message that you gave, very, very important. And you also touched upon very interestingly how derivatives are different from physical commodities. In fact, this is one of my favorite slides that I show when I teach markets. And I said very, very clearly, in the physical market, when you trade commodity, there is something called a counterparty risk. Whereas when you trade derivatives, the counterparty risk is minimal, because it is the exchange that is going to absorb all the risk, because it will be derivatives are exchange traded. And secondly, in a physical market, there's no mark-to-market, daily mark-to-market. But whereas in a derivatives trade, you have daily mark-to-market. Therefore, you know exactly what's happening to your investment. And the flow of information in the physical market, flow of information is rather poor, very slow. Whereas in an exchange, on a daily basis, regular basis, there is adequate flow of information in terms of how prices move, etc. Very important. And most important, for the derivatives market, you have a regulator. Sebi is a regulator. For the physical market, there's no regulator. Therefore, I think derivatives are in some way superior products to physical commodities themselves. But thank you very much, Vikram. I'm sure there will be a chance for us to come back to you to extract more wisdom out of you. And with this, let me now invite our friend Debjot from MCX to make his presentation. Debo, the floor is yours.
Thank you, sir. Thank you, everybody. Thanks to IMC for giving this opportunity to me for taking you through one of the elements of this topic about investing in commodities. The earlier two speakers have very eruditely spoken about why one should invest in commodities and the diversification benefits. One of the elements that they have touched upon, I will pick up from there. It's not about why, but I'll pick up the how. How do you invest in commodities? So having known that commodities give excellent risk-weighted returns, whether you measure by Sharpe ratio or anything else, risk-adjusted returns. The next question is how to do that. Now, before I say that, the audience also must appreciate over here that derivatives instruments are, as Chandrasekhar sir just now said, are superior instruments for investing in commodities. But in many respects, you will find that derivatives are the only instruments for trading in commodities. For example, if you have if you are long in, let's say, if you are bullish in crude oil, you think crude oil prices are going to go up significantly in the next 4 to 6 months. What option do you have? I am told that it is illegal. It's not only impossible, it is illegal to actually possess one drop of crude oil with you. You can't do that. and even if you are like possessing it and you are hoping to sell it in the market, so practically there is no physical market for commodities like crude oil. Even though you know that or you may have a view on it, the only way you can invest in crude oil and make some money out of it is through use of commodity derivatives like futures and options. World over, and particularly in India, exchange traded derivatives are the most popular, are safest, are most effective ways of investing in commodities. And therefore, that is what I want to highlight before starting my presentation over here. Now, in terms of the how do you invest in commodities? There is one animal that has entered into the market in the Indian markets just 2 years back, and my presentation is on that. Chandrasekhar sir had briefly mentioned about it. It is about commodity indices. So in 2019, December 2019, MCX introduced the MCX iComdex series of indices, which were for the first time real-time in India, the real-time commodity futures based indices, which were disseminated live with a history going back to December 2015. And this was started in 2019, December 2019. And 8 months later, in August 2020, MCX launched the first futures contracts on one of those indices, which is the Bullion Index, on MCX Bullion Index. Subsequently, other futures on other indices were also launched. So I'm going to briefly present on these, as I said, for want of a better word, animal called commodity indices, and particularly I am going to talk about the MCX iComdex indices. Just give me a second. So, as an introduction, I would just want to highlight why do we need, index derivatives in a country like India. So I think the previous two speakers have dealt upon this, but nevertheless, I will just highlight on this fact that it is a convenient means, convenient not only in terms of the, cumberness of, holding commodities or trading in commodities, but also the cost. It is the trading costs are lesser if you are wanting to trade, if you are wanting to take exposure in a basket of commodities. The trading cost is lower if you are investing in indices vis-a-vis if you are wanting to invest in the commodities. I'll give you the example of, let's say, the metal index. MCX has a metal index also. So it consists of 5 base metal futures. Now, if you are bullish on base metals, but you do not know which commodity, which of these 5 metals are going to, the prices are going to rise, probably you are having to will go and trade in all the, you are going to take exposure on each of these 5 base metal futures. 2 of them actually have options also. However, this one instrument, which is the futures on the base metal index, is going to give you the same exposure in all the metals simultaneously at a lesser cost. There is cash settlement, which means there is no delivery, there is no threat of delivery, no risk of delivery, and you can keep your positions open till the last day of the contract, and you are not going to get into delivery. And therefore, it is a very effective tool for, a very convenient tool for portfolio diversification. Also, understand the fact that it can be used to hedge against exposure to the specific sector. Again, I will give this example of base metals. So if you are actually having exposure to base metals because you are a physical trader in base metals, one of the ways by which you can hedge is by using this base metal index rather than any of these or all of these base metal futures or options for that matter. So index allows you to even take a hedging position apart from taking an investment position. Then there is this arbitrage opportunities with the underlying futures. Again, taking the help of base metals, there could be arbitrage opportunity between the base metals, the underlying base metal, that's the copper futures or zinc futures, and the metal index or the base metal index. So these kind of arbitrage opportunities would be there, which would be a good opportunity for the investor to use and make some risk-free money. Apart from that, also understand the fact that this is good for the market as well, because it enhances the liquidity of the underlying market and improves the price efficiency of the market. So it is a win-win situation for both the markets as well as the market participants. And of course, India today is at a position where we can and we need to have instruments which are available throughout the world in all other major global exchanges. And therefore, there is no reason why we should not be having commodity index and commodity index based derivatives instruments. So for example, the CME group, which is world's largest commodity exchange, on it is traded the S&P GSCI index. Also the Bloomberg Commodity Index, also called BCOM. On the Eurex, which is a prominent commodity exchange in Europe, the Bloomberg Commodity Exchange is traded, and they are quite liquid and quite heavily traded. And therefore, these kind of instruments and this kind of the demand for this kind of instruments are there in those countries. And natural and logical reflection is that this kind of the demand for these kind of instruments are there in India also, which is why we can and we do have commodity indices and futures and options. We don't have options as yet, but futures on for some of these commodity indices. So let me tell you briefly about the MCX ICOMDEX indices. They consist of the single commodity index, the sectoral commodity index, and the composite commodity index. Single commodity indices are found for gold, silver, aluminum, copper, lead, nickel, zinc, crude oil, and natural gas. So as you can see, on the bullion commodities, the 2 bullion commodities, on the 5 base metal commodities, and on the 2 energy commodities, there are single commodity indices. They are these indices are constituted of one single commodity, whichever. So gold is constituted of the gold futures, silver is constituted of the silver futures traded on MCX. These form the sectoral indices. The single commodity indices form the sectoral indices. Currently, we have 3 sectoral indices: one on bullion, one on base metals, and one on energy, popularly called Bulldex, Metaldex, and Energydex. And then we have a composite index, which is also called the MCX ICOMDEX Composite Index, which consists of 11 most liquid futures contracts traded on MCX. All of these have the base year as the close on 31st December 2015 and a base value of 10,000. Whatever value you see today, the base value is 10,000. Some of the basic, the indices are computed and disseminated real time and continuous. And as I just now said, the sectoral and composite indices are built over single commodity indices. So first, the single commodity indices are created, constructed, and from them are constructed the sectoral and the composite index. So how are the single commodity indices constructed? They reflect the movement of front month futures or the near month futures, and they roll over the constituents, which are the futures contracts. They roll over from one contract to the next month contract, which means from the near month contract to the next month contract over a period of 2 days. Now, why is this concept of rollover important, and why one should understand this? Because please remember, unlike let's say the equity indices, the commodity indices are formed from futures prices, and futures contracts, as you know, they have a life. They start on a particular date and they expire on a date. So before expiry, the index should get rid of the contract which is expiring and go over to the other contract. So this getting rid from one contract to the next contract, or in other words, from the near month contract to the next month contract, is called rollover. And this takes place not abruptly, but this takes place gradually, smoothly over a period of 2 days. So which is what is called the concept of rollover, which is found only in commodity indices, and you will not find this in the other indices like the equity indices. And this rollover usually is before the 5-day delivery period. So whether it is gold, silver, or the base metals, the last 5 days of the contract are the delivery period of the contract. Before the contract enters into delivery period, this smooth rollover from the current month to the next month takes place, which gives the concept of rollover. I'll explain in the next slide, but then also please understand that this is the reason why the commodity indices, the ICOMDEX commodity indices, are also called excess returns indices, because this rollover gives rise to what is called a roll return. That means over and apart from the price return is a simple return because of the difference of the price. The difference in the price between the near month and the next month gives rise to a roll return. It could be positive or it could be negative. So this price return plus the roll return gives rise to the actual return of this index, and which is why the ICOMDEX indices are called excess return indices. This feature is found only for these commodity indices which are constituted of the futures contracts, because of the fact that they are constituted of futures. Coming to composite or sectoral indices, they are simple weighted index based on the single commodity indices. So as I told you, they come from single commodity indices, and the weights are based on liquidity and physical market size. Liquidity is given 75% weightage, and the physical market size of the constituents is given 25% weightage. So any single commodity index, when it goes and forms the sectoral index, that's a copper index goes and forms a part of the ICOMDEX base metal index. In that, it has got a weight, and that weight is based 75% on the liquidity of copper futures on MCX in the last 12 months, and 25% on the physical market size of copper in India on an average in the last 5 years. That gives rise to a particular weight, and that is the weight of copper in the MCX ICOMDEX base metal index or metaldex. Every year, the indices are rebalanced. They are rebalanced once a year, and it is announced in October every year, and which comes into effect in January. So very recently, in the month of October, we have announced the weights which will be applicable from coming January, 2 months later, and we have done the rebalancing based on this liquidity of the contracts in the last 12 months and physical market size of the last 5 years of each of these commodities. So basically, if we were to draw a comparison quickly, we have some time here, between the equity indices like Nifty or Sensex and the commodity index like MCX ICOMDEX indices. The tradable index type, as I just now told you, it is an excess return index, unlike the equity index, which is a free float market cap index. The constituents in the equity index are cash prices of the equity stock. Here, these are commodity futures contracts. The weights in the equity indices are based on the free float market capitalization. Here, based on the liquidity and the production value, which I just now said. In the equity indices, very frequently, corporate actions lead to some kind of an index adjustment. In commodity index, once it is fixed, once the weights are fixed, there is no adjustment required, generally, unless there is some disruption in the market. Rollover, as I just now explained, it is not applicable for the equity index, but in commodity index, you have this concept of rollover because these indices are based on futures prices which expire, futures contracts which expire. The rebalancing in India, mostly they are semi-annually, once in 6 months, the stock exchanges do the rebalancing. The commodity indices are rebalanced once a year only. Coming to the futures contracts on these indices, the final settlement price is based on the closing price of the underlying index on the expiry date. So if it is Bank Nifty or Nifty 50 or whatever, any of these indices, you know that on the last day, whatever is at the time of expiry, whatever is the closing price, that is the settlement value. In commodity index, there is something called VWAP. That means volume weighted average price, VWAP, also called VWAP. Volume weighted average price of the constituents during the last 1 hour. This is not last 1 hour actually. Yeah, I mean, this is the contract expire at 5 p.m. So last 1 hour, 4 to 5 p.m. on the day of expiry. So again, giving the example of metaldex, the base metal index, if the contract is expiring today between 4 p.m. to 5 p.m., the prices of the constituents, each of the 5 constituents, copper, zinc, lead, nickel, and aluminum, whatever is the volume weighted average price during that 1 hour period, 1 hour window, that will give the final settlement price. So it is a little complicated, not directly the closing price of the underlying index. I'll briefly touch upon the construction. not to go too much into the details, just to know that, let you know that there are two parameters that one needs to understand once before one trades in these commodity indices. One is the eligibility criteria. I just now told you that we look at the liquidity, which is the turnover in the last 12 months. The eligibility criteria for each constituent is that it should be in existence for the last 12 months or more, and they should be traded for at least 90% of those days in those last 12 months or more. And the minimum average daily turnover should be 500 crores at least, average daily turnover for metals and energy, and 75 crores for agricultural commodities. Coming to the weights, I just now told you the 3/4 weightage is given to liquidity and 1/4 weightage is given to the production value, which is the average deliverable supply in the last financial year, 5 financial years. Then there are these ceilings and there are these floors for these indices. So the composite index can have maximum 30%. Like after calculating the weights by the first 2 points, as you can see, liquidity and production value, it is possible that for some commodity we get a 32% or 35% weight. However, we need to cap it at 30%. Similarly, there has to be a floor. No commodity constituent can have a weight less than 2%. So the maximum can be 30% and the minimum can be 2%. This is for the composite index. For sectoral index, and similarly, we have ceiling and floors, but then they are slightly different. Mostly it is 40% for 40% and 2% if the sectoral index has more than 2 commodities, or 75% is the max if it is with 2 commodities. Like energy index, MCX energy index, it has just 2 commodities. So the maximum any constituent can have is 75% weightage. So based on this, we have calculated the weightages, and as you can see on the screen, these are the 20. I have put out the 2021 weights and the 2022 weights. 22 weights will come into effect January onwards, coming January. So right now, as I'm talking to you, all the indices that are that you see on the MCX website or on which there are products, they are taking the 2021 weights. Whether this is for the composite index on the right side or any of the sectoral indices, which is on the left side. Come 22, this will change. So there is a very strong, governance practice followed for, in respect of these indices. There are lots of disclosures and disseminations being done, and most of these are following the regulatory guidelines, or some of them are following the international practices, international guidelines. So one is that the methodology document, which is the Bible of the commodity indices, which includes the computation, the rollover dates, rebalancing, everything about the index. It is a public document which is available in the public domain on the MCX website. And this is also like nothing can be beyond and over and apart from what is given in the methodology document. So this is, as I said, the Bible. Then there are this index fact sheets for which is also available to everybody for making people understand about the indices. There is a grievance redressal policy and grievance redressal mechanism. If anybody has a complaint, one can make a complaint. This, how to do and how to get the grievances redressed are all put up on the website. Then there is those IOSCO principles. IOSCO stands for International Organization for Securities Commissions. Now they have come up with some principles for for good governance of these benchmarks like indices. Globally, these are applicable, and the best indices globally follow those IOSCO principles. MCX iComdex indices follow these IOSCO principles, and not just follow. Every year we get these, examined by an audit firm, and the report of the audit firm is also put out in public domain. This is all to say that there is a high level of transparency and high standards of governance being followed in the administration of these iComdex indices. The notifications and any change are put out in public domain, and the price history are available 2015 onwards, and they are disseminated widely through trader workstations, TWS, tick by tick feed, website, etc. And anybody and everybody who wants to take a live feed of these, this index values are free to approach MCX, and those values can be provided. So I will quickly go through this. The governance, as I told you, we have an administration team, and then there is an oversight by the Index Action Committee and Advisory Committee, and then there are these periodic audits. So I'll conclude by showing this returns and volatility of these indices over the last 5-6 years from the period of inception. Let's say from 1st January 2016 onwards. So as you can see, these numbers are all there. The vertical table gives you the volatility and returns of each of these indices. So for something like base metals, FY21, of course, this is still August. I have not included September and October. It was given a return of some 48%. That is not to say that this kind of returns you can get every time. Like the Bullion index from April to August, the return was about 1%. So one needs to take understand that take an educated view about what these returns mean and what period it refers to. I would want to focus your attention on the bottom table, the horizontal table, which shows the correlation. The correlation of returns with several other asset classes like Nifty and dollar index, the gold futures, and all of this. As you can see, for each of these three traded commodity indices: bullion index, metal index, and energy index. So particularly, please see the correlation with Nifty. It is for bullion. This is over the long period, 2016 onwards till now. It is -3%. For base metals, it is about 13%, and energy index about 17%. It has never crossed 20% in this broad 5-year period, broadly 5 or 6-year period, which is to highlight the the topic of the theme of today's discussion, which is the diversification benefit. So this is one. The other one is about the correlation with the US dollar index. As you can see, for bullion index, I'm not highlighted. It is about -32%. For base metal index, -16%, and energy index, it is about -1%. The correlations are really, really low. It's not about whether it is positive or negative, but it is quite low, which is what diversification is all about. So if you take positions in index and keep your positions for a significantly, so 3 to 5 years, you are having your positions open, you can definitely get this kind of a diversification, realize this kind of a diversification benefits. So this is all I have to say in my presentation.
Sorry, friends, I briefly lost connection. I'm back. Debo, thank you very much for your presentation. It's wonderful. You talked about index, of course. You discussed the salient features of index trading, how index is constructed, what goes into it. But the best part was the last correlation that you showed, which makes a very strong case why diversification in investment, particularly through the derivatives route and using index, will make a lot of sense for investors. Now, I have an announcement to make for all the participants. If you have questions, please post them with your name in the chat box, and we will request the experts to share their thoughts on your questions. But what is also important is there is one. Quite apart from whatever we discussed over the last 1 hour, there is one fundamental or a more basic question. Why should we look at commodities, or why should we invest in commodities? People are saying, oh, I've been investing in equities, and and I'm very happy. Why should I diversify into commodities? I want to mention that that insofar as our country is concerned, India is concerned, our economy in the coming 5, 10, 15, 20, 25 years is going to be substantially driven by commodities. Our growth is going to be substantially commodity intensive and commodity driven. Number one, commodities are going to play an increasing role in our lives and in our economy going forward. Now, there are 4 or 5 major sectors of growth as far as India is concerned. One, of course, is agriculture and food. Second is textiles and clothing. Third is housing and infrastructure. Fourth one is energy. Fifth one is transportation. And there are 3 more, which are obviously healthcare, education, and of course, leisure. But healthcare, education, and leisure are services. Whereas the first 5 that I listed, food and agriculture, textiles and clothing, housing and infrastructure, energy, and transportation, all these growth sectors for India are highly commodity intensive. Without commodities, these sectors will not grow. And these sectors are destined to grow in our country. When we talk of agriculture and food, we have to discuss agriculture commodities. When we talk of textiles and clothing, fibers will come in, whether it's natural fiber or synthetic fiber. Housing and infrastructure, nothing but commodities, steel, cement, base metals, etc., etc. Energy, nothing but commodity, whether it is crude oil, natural gas, coal, or whatever else, is all commodities. Transportation, it's all commodities, particularly with the revolution that's coming in, that is electric vehicles, which is going to be commodity intensive, metals intensive. All that's going to have a big impact on India's commodity market, and therefore it's going to touch our lives even more in the coming years. And therefore, it is important to look at commodities as a major avenue for investment for all of us. I think that's important. And again, as Vikram pointed out very specifically, and I mentioned, product knowledge and market knowledge is extremely important. Therefore, investors and market participants must seek constantly product knowledge and market knowledge before they get into investing in commodities. And therefore, I think that's important. Knowledge for investors will certainly deliver, because knowledge is power. Now, I'll get back to Mr. Vikram Dhawan. Vikram, do you have any more thoughts to share? If you have some words of wisdom for the participants.
So I think, sir, you covered a lot of ground, and I think the most important thing which every investor should, look when looking at the commodity derivatives market is that, you will have, a journey in the market. I mean, when you start investing in derivative market, and so let's say if you have not invested you haven't yet invested into derivatives, you'll start someday, right? So you'll have a journey in that, and to make that journey beneficial and most importantly enjoyable and a learning this thing, it's very important to first of all, people ask me, which is I give a lot of seminars on precious metals. The one question which I always ask is, can you suggest a book which we can read? And so unfortunately there are no. You read books, read social media and all those things, but unfortunately there is no E is equal to MC square equation which is invented, which will increase the your wealth. So there are even the models also. Yes, sir.
Sorry for the interruption, Vikram. Let me share. At least over the last 10 years, I've been under tremendous pressure from various quarters, including policymakers, believe me, and bureaucrats. Now, Chandrasekhar, why are you not writing a book? And this book is required. At least the basics of commodities, share. And I am basically a lazy guy. But it's all there. It's all there. I need to sit down and start writing, but that has not happened in the last 10 years. I'm hoping that since you mentioned that there is need for a book, at least the basics of commodities, particularly that suits our Indian conditions. Maybe
Right,
I should I should start writing. But thank you very much. Sorry for the interruption. Please go ahead.
Yeah, absolutely. So that will be a book to look forward to by all of us. But I think you need to be very careful on how you make decisions. And the more rule-based your decisions are, the more chances of success that you have. You know, whichever sports you play, whether it is cricket or whether it is football, while we see, when we are seeing on the television, it looks very different. But if you go and ask the player, they would always say, you know, I played this shot because there was a 70% chance of succeeding. Or I bowled this ball because there was a 60% chance of succeeding. So we are living in a world of probabilities. You will not get anything 100% right. And if you're getting something 100% right, this means it's time to take your money and run, actually, because the law of average is going to go against you. So it's a probability game. And the more rules you have, don't tie yourself with your rules, but there should be some basic rules. The more rules you have, at least at the end of the day, you will know how much money you can make or lose. And that itself is a very important thing. Today, investors reward those companies, businesses, professionals who can forecast with some sort of accuracy the upside and the downside. Similarly, if you become a trader or an investor who you yourself can forecast the amount of money you will make or lose in the next 1 year, then you have become a blue chip, actually. So keep that in mind before you start your foray into derivatives.
All right. Thank you very much. I think it's very important. I remember having seen a video where a minister asked Sachin Tendulkar, how are you able to score so many runs, so many centuries? You're able to save India. You're able to bring India to victory, etc. What is it? What is cricket? After all, you're hitting a ball with your bat. He said, sir, it's not as simple as that. It demands skill, and you need to acquire that skill. And therefore, in investing also is a skill, and you can acquire the skill. It's not rocket science, but you need to acquire that skill to invest. And then that probability theory. There's a 70% chance that I'll be able to hit this ball to the boundary line, or I'll be able to get this wicket, or whatever. I think, and therefore, I think that's important. Very, very nice. And again, when I teach, I also talk about 4 requisites for a fairly successful commodity trader or commodity investor. What is it? One is capital. You need some capital to start with, at least to pay mark to market, etc. You need capital. Second, of course, is knowledge. You need product knowledge and market knowledge, which all of us all the time emphasize. Third, we need strategy. The investor needs a strategy, entry strategy and an exit strategy, as Vikram pointed out. And we have always believed the exit strategy is more important than even the entry strategy. You can enter the market anytime, but you should know exactly when to exit, when to book your profit or when to cut your losses. So, the strategy. Fourth is discipline. You have to be extremely disciplined in your investment decisions and entry and exit strategies. It's not it is not like investing in a particular share, forget about it for 3 or 5 years, and then you wake up one morning, the share prices have gone up, and then you sell and make money. Commodity markets are that way, unlike the equity markets. Commodity markets are a lot more volatile, and therefore you've got to be glued to this market to benefit from the market volatility. Do you agree, Vikram?
Yes, absolutely. I think, as they say, horses for courses, each market is different. You know, like The other extreme is the debt market. You can buy a bond and go up to sleep for 10 years, especially if it's a tax-free bond, which you cannot do if you buy copper or aluminium or crude. So they're two different markets. Yeah.
Absolutely. Debo, any thoughts, anything you want to add beyond what you said in terms of diversifying the investment portfolio for investors? Before I take up the Q&A, I see some questions. Therefore, I'm just thinking, Debo, if you have any.
No, so as I said, so since I dealt almost entirely into index investing, I think this is a very convenient tool. And because of several reasons that I said, and sir, you also spoke about all of this.
Correct.
Yeah, so one needs to understand the benefits of index investing and get into the commodities through the index route. It's a very convenient route. So for the ones who are entering into the commodity market for the first time, try and use the index route for initiating your trades.
There is, let me go into the chat box. I'm seeing one question from Anand Agnihotri. It says, isn't cryptocurrency promote criminal activities in India, or is it safe due to SHA 256? What's your view? Personally, I would refrain from answering this question. But if Vikram or Debo has an answer, because this is not the topic of discussion today. We are discussing commodities. And we are discussing commodity derivatives of portfolio diversification. This is not on cryptos, and therefore I would refrain from answering. Any comments from you, Vikram or Debo?
I'll just make a one-line comment on this since the question is asked. See, today, as Chandrasekhar ji very rightly pointed out, commodities is a regulated market. Crypto is unregulated Wild West.
Absolutely.
So, making money is one thing, and getting your money out and getting it in your bank is another thing. So, good luck with that. If you can do that, then fine. Pat yourself.
Any market where there are a large number of people playing that market without a regulator is a risky market and is probably in some way ripe for a scam. Okay, I think this is my thought, a very, very personal view. Although this has nothing to do with the crypto advertisements, etc. But this is how we have seen it. Okay. Informative event. Manju says, please share the presentation. Yes, I think we will. Nikhil Jain, I think we'll, I'm sure, upload it on YouTube. And Anita, make sure that all the participants get the link to the YouTube whenever it is uploaded, maybe in a couple of days. What is the benefit of investing in gold, commodity, or indexes over sovereign gold bonds, physical bond? Nikhil is asking this question. Debo, you want to respond, or even Vikram for that matter?
Yeah. So, I mean, these are all different, assets. We should not be comparing. So, sovereign gold bonds, they have a particular purpose. Physical gold, physical gold for holding for investment purpose is not really a good idea. In 2021, probably, a few 100 years back, we didn't have an option. So that was what we did. But physical gold, of course, I mean, given all the, the problems about holding physical gold, that's not really an option. Sovereign gold bonds have their own, I mean, these are two completely different animals. One cannot compare this. For example, in gold commodity, I'm assuming gold futures you are referring to, or indexes, you get the benefit of, margin, you place with a 5% or 11% margin, and you take exposure to the entire, whatever the asset. It expires, all of those, paraphernalia that goes along with it. Those you don't have. But of course, sovereign gold bonds, you also have to, settle yourself for a longer lock-in period. So the liquidity issue probably will come into the way, which is not what you get in, the Buldex or the gold futures.
And then one last question, which we will take. What's the benefit of trading in index futures when compared to other securities? But I thought you had mentioned, Debo, the benefit, but maybe very quick recap if it's possible.
Yeah, so index futures, you have, as I said, you don't get into delivery. Unlike, let's say, in gold or silver, if you are holding gold futures or silver futures, the last 5 days are the delivery period. So if you're keeping your positions open, you may be asked to take delivery or give delivery. The same doesn't happen with Bulldex or the gold, the bullion index futures. So that is one big advantage of having this. Also, the other advantage is that it's a basket. So again, I give the example of metals. The 5 metals form one basket. So you need to have your view only about base metals, which way the prices are likely to go up or down, and not really bother about whether copper is going down or lead is going up or aluminum is going up. So that sectoral view is what you need to have in order to trade successfully in this, rather than views on each commodity.
All right, thanks. There is one more question which perhaps Vikram can take. Isn't gold an unproductive asset because it's not as such used in the economy? What are your thoughts?
Well, unproductive, yes, in the sense that it doesn't give you any dividend or it doesn't give you any coupon. But despite that, it is, if you see the historic returns of gold in the past 50 years, it's in the excess of 10 to 11%. Even our own gold ETF, which was launched in 2007, has given a CAGR in excess of 11%. So, well, I would take 11%. If somebody gives me 11% for the future, I would take it. And much better than fixed deposit, isn't it?
Exactly. And nobody is saying put all your money in gold. Nobody is saying that.
Yeah.
But use gold as a portfolio diversifier. Maybe 10%, 15% of your total investment could go into gold, because historically, if you look at gold prices over the last 100 years, I'm sure they have kept pace with inflation. And as I mentioned earlier, I remember from the year 2000 till 2012, gold prices increased double digit year on year. I think that was an extraordinary bull run, and went to probably $1,800 or $1,900 an ounce, and therefore I think it is a good investment option.
Also, one disclaimer, sir. Disclaimer I would like to give: just because gold is given 10-11% on a historical basis, there is no guarantee it will continue to give that.
Absolutely. That is, past performance is no guarantee for future returns. Very clear. Absolutely correct.
I am reminded of a very old English saying. I think it is more about 1,000-year-old English saying. In good times we have gold, in bad times we have fear. So this is what I wanted to draw attention of whoever is asking about the safe haven element of gold. So in terms of in bad times, or in times of some disruption, uncertainties, you will find gold prices are going up because everybody seems to be having more faith in gold than any other asset class.
Gold
so
is
therefore,
a safe
as
haven.
you said, rightly said, safe haven.
Safe haven investment. Absolutely. How to do short selling, sell high, buy low? I think no. I think we will. Sorry, I think we should. I don't know if you want to answer.
So
I would just
since we're talking of the commodity markets, unlike in the equity markets, you actually can take a position in the commodity futures. I'm saying futures by actually going short. Okay, and it's different from. I mean, you can take a long or you can take a short position. So that doesn't mean that you actually have to deliver. It is because it's electronic trading, so you can actually take a short position just like you can take a long position, and your risk in terms of the market going the other way is as much in a short position as you is in a long position. So please try and understand the difference between short selling, which is in the equity market, and taking a short position in the commodity futures market.
Very well. Very well. I think it's well past 5:30. It's time for us to conclude. I want to thank Vikram Dhawan for his time and for sharing his very, very erudite views. I want to thank my young friend Debo from MCX for again being a part of this. Thank you, Debo. IMC thoroughly enjoys working with MCX and for conducting these kinds of events. I hope we will continue to do so. I also want to thank, of course, Anita Naik and the IT team of IMC for organizing this. With this, I think we will conclude today's event. Good luck. God bless you all.
Thank you.
Stay safe. And we will meet again. I'm sure there are many more events on the annual. And Anita will keep sharing circulars and emails to all the participants here.
Sure.
Okay. Thank you
Thank
very
you.
much.
Thank you, sir.
God bless. Stay safe.
Thank you, Vikram. Thanks.
Thank you very
Thanks.
much. Thanks for
Thanks,
inviting me.
Vikram. Bye. Thank you.
Bye.
Bye.